Hey folks, Jeremy Whaley here from Trade Maestro. Hope you're doing fantastic today. And I want to share with you how you can avoid losing all the money in your trading account. This is a pervasive problem, especially with retail traders. The biggest thing that separates the professionals from the retail traders is their ability to, in the case of the professionals, to keep the money and not blow out the trading account, whereas the amateur traders tend to really mismanage their funds. So what stimulated this is a couple of my private clients that I've been working with have had a similar problem to each other, two people in particular. And in their case, what they're looking at is they're winning 70 or 80% of their trades, sometimes more, but they aren't seeing their account values go up. So if that's something you've seen where you're winning trades, but you're just not making money, you end up losing more than you make and you can't figure out why. Well, I'm going to share with you the secret for how you plug that hole so you don't have these devastating losses. Because there's nothing that's more frustrating than seeing winning trades and not seeing your account going in the right direction. So that's what we're going to talk about after we get to the other side of the disclaimer. So let's watch the disclaimer and I'll be with you on the other side. All right, if you've not been to TradeMaestro.com and gotten yourself signed up for some free stuff or joined our membership or one of the other things over there, then please feel free to go over to TradeMaestro.com so you can find out all the things we've got going on. What we're going to do today, I've called this Avoid Big Devastating Losses When Trading, and this is the number one technique that you can use. I didn't read that very well. Avoiding Big Devastating Losses When Trading. The number one technique. There you go. There's a good YouTube title for you. All right, so like I say, I set this up with having a lot of winning trades, but you're not seeing your account go up. How do we stop that? It's a very easy fix, but very few people have the discipline to do it. There's Mark Twain who very famously said, the return of my money is more important than the return on my money. Yes, thank you, Mark Twain. And that is the truth. How do we make sure we don't lose our capital, our core capital that we have to work with? Because once it's gone, it takes a lot of work to get all that back. So, or for most people it does. That's what we want to address. We want to address preserving your capital. And here's the rule. The number one rule when trading is to only take trades where you can earn more than you put at risk. So just write that down. I'm going to unpack this over the next 15, 20 minutes, however long it takes to get through it all. But the rule is you can only take trades where you can earn more than you put at risk. And the fancy word or the fancy phrase we use for this is your risk-reward ratio. Risk-reward ratio. This is the secret. And I've taught this for years. If you've watched me teach, you've probably heard me teach it before. Doesn't mean you've done it, but you've heard me teach it. Managing your risk-reward ratio is hands down the most important thing for making sure that you don't go broke. If you don't manage this risk-reward ratio, you're going to end up just whittling through your trades. So that's why I want to address it again. For some of you who are new, it's something new for you. For those of you who maybe seen it before, it's a reminder. If you're having the pattern where you're not making money, you're not seeing your account go up, but you're winning trades, this is almost always the fix. There's a couple other things that might be at play, but very, very rarely. This will fix like 99% of the cases. So I want to say this too, before we go any further here, you should only have to win about 33%, maybe 35% of your trades to see your account go up. Okay, so write that down. How many trades should you be making money on? If you're making money on 1 out of 3, that's basic market odds. Remember, the market can go up, it can go down, it can go sideways. So at any given time, if you just throw a dart and pick a stock, you got a 33% chance of making money with it, right? So if you trade at basic market odds where you're winning 1 out of 3, you should see your account going up if you do this process right. So just look at your own account. How many winning trades do you have? Do you have 5 out of 10, 6 out of 10, 7 out of 10? Most of my clients are somewhere between 6 and 8 out of 10, 60 to 80% of their trades that they make a profit on. And then they wonder why their account's not going up. Well, it's because of this right here that I want to share with you. It's always found in the risk-reward ratio. So what is risk-reward? The principle is that you need to have a greater reward than you have risk on every trade. And if you do this, you will win. Just understand that. If you have a greater reward than risk on every trade that you take, if you do that over time, you will win. Okay, so here's the truth. You can take a screenshot of this. I'll take it full screen for you. People tell me I win 70-80% of my trades, but my account goes down. If this is true, every time the fix will be found in managing your risk reward. Now, there's oftentimes confusion that is surrounding this concept of risk and reward. People often think that risk is the same as capital, and it is not. So make sure you write that down too. Risk does not equal capital. Capital is the amount of money how much money it takes to place the trade. Risk is how much you're prepared to lose. Now, I know most of you are not prepared to lose anything. That's why you're always shocked when it happens, right? As a trader, as a professional trader who has a trading plan, you go into that plan with an allocated amount that you're willing to lose if it comes to that. And, we never want it to come to that, but just the mere fact that it's the stock market, it's going to happen. So you've got to learn how to manage that risk, okay, that downside. So here's your ideal numbers. Ideally, you must have a higher reward than risk, and the ratio should be 3-to-1 or better. That's the ideal number. There's a lot of traders. I say there's a lot. There's some hedge fund traders who are pretty famous. I won't mention all their names, but who restrict themselves to only doing 4-to-1 or better, or 5-to-1 or 7-to-1. They only take a small number of trades, but the ones they take have a huge reward to risk ratio. Now, if you're trading options, I'll tell you it's acceptable to do 2-to-1. If you're trading stock, you can get away with 2-to-1 reward to risk ratio. It's not ideal. Ideal, you want to try to find those 3-to-1 or pretty close to the 3-to-1 reward to risk ratios. If you're trading options, because of this little magical thing called the delta curve, the 2-to-1 reward to risk ratio actually will show up in the option as about a 3-to-1 reward to risk ratio. So I don't want to get into math on it, but just trust me on that. Now, if you don't quite understand this yet, I'm going to go into some more numbers. I want to kind of spill the beans first and show you what the principle is, and then I'll kind of show you the back door for how we calculate all this. I've taught this for years. I never can figure out which I should teach first. If I should show this part first and then teach the numbers, or if I should teach the numbers, which are really boring sometimes, and then come back and show how it works. So I don't know. If you want to see it the other way, just fast forward and then come back to this part. All right, so what I've got here on the screen, this is a spreadsheet. On the left over here, I don't know if you can see my cursor or not, but on the left, you see 0.5-to-1. That is the reward that you're getting for the trade. If this trade does what you want, you're going to make 50 cents, and you're taking a risk of $1. So can you interpret that right? And just understand that's always the ratio we're looking at. What is my reward for the risk that I'm taking? Okay, so in this particular example, if I get a reward of 50 cents, that means that the trade does what I want and I make 50 cents per share, and I'm taking a risk of $1, I have a 50 cents to 1 reward to risk ratio. Okay? You need, out of that, in order to break even, you need 6.7 out of every 10 trades to win, which means you have to have a winning percentage of 67%. Now, if you're winning 67% of your trades, you could take this trade and you would break even over time. The challenge is, if you know anything about market odds, 67% is double market odds. I just explained this, but I'm going to explain it again. The market can go 3 directions. It can go up, it can go down, it can go sideways. So if you're buying a stock or if you're buying an option and you're expecting the stock to go up, that's one of the 3 directions it can go. If you're buying the stock and it goes sideways, you don't make any money. If you buy the stock and it goes down, you lose money. So your probabilities of making money are 33%, 1 out of every 3 directions of which way it could go. So that's your basic odds of the market. Okay. Now here's the question. Let's flip that upside down. When you place a trade, do you ever think to yourself, I only have a 33% chance of making money? Or do you say the opposite, which is also true, I have a 66% chance of losing money? And if the answer is no, you don't say that, then that also reveals why you might be placing a bunch of trades, winning some, but you're losing more than you're making. It's really important to be an effective trader to understand these odds, these market odds. I hate to use the word odds, but that's really what it is. It's just the probabilities of it working or not working. Now, we can increase those odds with better market analysis. We can increase it with better strategies, but I always want to build a trading system and a money management system around the idea of the basic market odds, which is 33%. Every trade on its face value has a 33% chance of making money. Okay. So now let's come back to our graph here, and you'll notice if I have a 0.5 to 1 reward to risk ratio, I have to win 67% of the time. My gosh, I have to beat market odds by a factor of 2 just to break even. Now you understand why it's so bad. You can't get away with it. You cannot make money if you're only making 50 cents for every dollar that you lose in the market. And I see these trade setups all the time where people will say, well, there's the next resistance, and so that's my target. And then they set their stop where they set it, and the reward that you're going to get is about 50 cents or maybe 75 cents, and their risk is $1 or a little bit more. And they might win 6 or 7 of those out of every 10. They have a very high win ratio, but they're not making money. Why? Because the losing trades are wiping out their wins. That's why. So let's go on down our graph here. What if we go to 1-to-1? People would think, oh, 1-to-1, that must be really good, 50-50. If I win half of my trades and I lose half of my trades, I'll break even. Well, that is the number. If you win half and you lose half, you'll break even-ish. Depends on what you're paying for commissions, and you also have opportunity costs. So 1-to-1 is really not a good risk-reward ratio either. It starts to become interesting when we look at a 2-to-1 or better. If you can earn $2 for every dollar you put at risk, so if you have a $2 reward for every dollar you put at risk, look, you only need to win 3.4 out of every 10 trades. That's 34%. Whoa. What? Yes, that's exactly what I said. It's 34%. That is basic market odds. 1 out of 3. If you divide 1 by 3, what is it? You get 33.33333, right? 34%. If you trade at basic market odds, which means you basically throwing a dart at the screen and you're picking a chart or picking a stock, if that is your ratio and you just basically do nothing but trade at basic market odds, as long as you can manage a $2 reward for every dollar you put at risk, you'll break even and you're not going broke. Now, that knowing those numbers, that is freeing. And maybe you don't quite comprehend it yet, but once I understood this, first of all, I've never blown out a trading account since I understood this. But secondly, it was just unbelievably freeing because now you have a mathematical formula for what you need to do. Okay. And it's no longer about how many winning trades you have, but rather it's about managing the risk that you're working with. Okay. Now, if you look at 3-to-1, this is much better because if you can earn $3 for every $1 that you put at risk, you only need to beat the market 25% of the time. That means you can trade basic market odds and still outperform the market. And that's why you see professionals say a minimum of 3-to-1. If I can have at least a $3 reward for every $1 that I put at risk, I'm going to beat the market. And now you add on to that all the other stuff that we do, the good analysis, the aggressive strategies and all that stuff, and suddenly everything changes. If you're one of these people who has bought into the age-old wisdom of buy and hold, and you've held through these big market swings and you're just frustrated because market goes up and it goes down and you never see the growth you want, you need to learn how to be an active trader. But the problem being an active trader for most people is they don't know how to react fast enough and they don't know how to manage their risk. And so what they end up doing is they might have winning trades, but they end up seeing their account go down. They give up. They go back to that buy and hold philosophy. They think that's really going to beat the market. It's not, especially in a market like we have right now, where the market's been essentially, the Dow up until now, depending on when you're watching this, has been very flat this year, hasn't done much at all. The other two indices have done fairly well, but we're still only like halfway back to recuperating our losses from last year. So just buy and hold, it takes a long time for that to work out. If it even works out, you can get those gains in 6 months, the gains that would have taken you 5 or 6 years if you learn how to do the active trades. But to do the active trades, you have to learn this piece of risk management. And this is what really separates the amateurs from the professionals. So if you'll just learn this piece right here, I promise you're only like that far from breaking free. All right, let's go ahead and go on down the graph here, the chart, whatever you want to call this thing, spreadsheet. If you do a $4 reward for every $1 risk, you only need to win 20% of the time. If you get a $5 reward for every $1 you put at risk, you only need to win 15% of the time. You talk about increasing the gains in your trading account, you start getting these higher 3, 4, 5-to-1 reward to risk ratios, and you add into the analysis that I teach you where you're winning 50, 60, 70, 80% of your trades, boom, everything changes for you. Just because you're marrying together the most important pieces of beating the market, which is, I always say, there's 3 steps to beating the market. What are they? Do the right analysis. Doing the right analysis, we can take a 33% probability of success and we can increase it to 50, 60, 70% or higher, okay? Just doing the right analysis. Add the right strategy to it. Now we've increased our probabilities of making money even more. You add this risk management piece to it, boom. It just blows up in a good way where you're stacking the deck in your favor. So you've seen these card players in Vegas or some of these guys that are professional gamblers and they really understand the numbers and know the odds. How do you make money in Vegas? You know your odds. How do you make money in the stock market? You know your odds. And guess what? This that I've just described to you, this thing right here, make sure you're making $2 for every $1 you put at risk, or make $2 or better, 2 to 1 or better, $3 for every $1 you put at risk. This is how the casinos win, folks. If you ever wonder, I mean, you go to Vegas and you see the casinos never lose, right? Why not? Because they've stacked the odds in their favor. And when you just do these couple little things, you too can stack the odds in your favor. So what I want to do next is I want to talk through the numbers. And I've kind of given you the key idea here. If this is all you watch of this video, then you've probably got what you have to have. But I want to walk through the numbers with you and show you how these numbers come to fruition. And then we'll go over to TradingView and we'll actually set one of these up so you can really see it. So what I want you to see here is the formula for risk reward. How do we get that 3 to 1 ratio? It's really simple. You just take your reward, whatever your dollar amount that you expect to make, and you divide it by your risk, and that's going to give you your risk reward ratio. So that's how we get to that part. Now, going a little bit further in these numbers, I want to clarify some confusion. Remember, the principle is we don't want to risk more than we plan to make. Okay, so that's the first, that I've said it like probably 20 times now. You don't want to risk more than you plan to make. The question people have is, well, how do I do that? It takes me $100 a share to get into a trade and I'm only going to make $3 or $4 a share. I'm risking way more. No, you've got to understand how we solve for the risk reward. So to solve for your risk reward, you have to have 3 pieces of information, and I'm going to put them full screen so you can really see them. Those 3 points of information for your trading plan are your entry price, your target price, and your stop. Entry, target, and stop. These 3 price points are everything that you need to write your trading plan and to understand your risk and your reward. So here's the formulas. Your reward, here's how we're going to define the reward. This is the amount of money you plan to make on the trade if the trade moves all the way to your target. That's our reward. It's the amount of money we plan to make on the trade if the trade goes all the way to our target. Now, I always break this down to a per share because it's a lot easier to do the math. You know, if you're trading 100 shares, great. But if you're trading like 72 shares or some odd number of shares, way easier to do your risk reward on a 1 share basis. So I'm going to make $10 per share. I'm going to make $12, whatever it is. Then you look at what your risk is. So here's the formula for figuring out your reward. You want to know how much you're going to make? Take your target price and you subtract your entry price, and that tells you your reward. Okay, so your target minus your entry, that gives you your reward per share. Now, as far as the risk is concerned, the risk, we're going to define it this way. It's the amount of money that you plan to lose on the trade if the trade moves all the way to your stop. So it's the amount of money that you plan to lose if the trade moves all the way to your stop. And the formula for that is your entry price minus your stop. That's how we define our risk. Entry price minus stop. Now, before we go any further, I want to just talk about this a moment. Statistically, most of you are not trading with stops. And I'm actually okay with that, kind of. I want to be clear here. I'm not okay with you just randomly buying stocks and holding them, and if they go down, you just whatever. You have to have a trading plan. I mean, you don't have to. There's no legal requirement, but if you want to be a good trader, you have to have a trading plan. And the 3 pieces you got to have are your entry, your target, and your stop. So your entry is where you get into the trade, your target's where you plan to get out, your stop is where you get out if the trade goes against you. Now you'll notice the way I language this here, the risk is the amount of money you plan to lose. Why would we plan to lose? We plan to lose so that if it happens, we're not taken by surprise. One of the biggest reasons people lose in the market is they never plan for it. They never account for the fact that, you know, I got a 66% chance of the stock going against me. They never think about that. Therefore, they never account for it. Therefore, when it happens, they hold on for dear life and they say, well, maybe it'll come back. And now we just went from a plan of trading into just pure gambling where we're just holding and hoping for the best, okay? That's not a plan. I never teach anybody to trade that way. So whether or not you actually execute a stop order, which we'll look at in some other videos, whether you do the stop order where it automatically sells the position for you, or whether you choose to use an alert or something that says, hey, this trade hit your stop, you want to go check it. However you choose to do that, you have to have the discipline to manage the trade and know when to get out. If you get to that price point, that exit price, that stop price, if you get to that price point and the trade's going against you, you have to have the courage to just get out of the trade. If you just hold on for dear life, I promise, now we can't build a system around it. We can't build a system because there's no structure to it. It just becomes gambling, and that's not any way to beat the market. So, said all I need to say about that. So we've looked at the price points here. Your target minus your entry is your reward. That's the amount of money you expect to make on the trade. Your entry minus your stop is your risk. That's the amount that you're prepared to lose on the trade. Now let's talk about the other term, and that is capital. Capital is the amount of cash required to execute the trade. The amount of cash required to execute the trade. That dollar amount will be 100% of the stock price or the option price if you're trading an option. So 100% of the stock price or the option price. Or if you're trading stock on margin, it will be your margin requirement, which is going to be 50%. But regardless of that's almost a secondary at this point. The way we define capital is it's the amount of money, amount of cash that is required to execute the trade. Now, the reason I'm bringing this up is most people, when they first learn about risk reward, they substitute risk for capital. They think that the amount of capital it takes to place the trade is the amount of money I'm risking. It's really not. And this is one of the reasons people are afraid to trade the stock market or crypto market or anything else, because they have this idea that the amount of money I put into the trade, capital, is all at risk. It's not all at risk. It's only at risk if you never close the trade, or it's only at risk if you just buy and hold and hope for the best. That's the only time it's at risk. When you do a plan, when you do a trading plan, and you know exactly what you plan to make and what you plan to risk, now you know your actual defined risk. And that's the way we teach people to trade. That's the way professionals do it, okay? So that's why I needed to define capital. Hopefully you understand that better now. Just for good measure, here's what ROI is. ROI stands for your return on investment. And this is the percentage of gain relative to the capital that you put at risk. So the percentage of gain relative to the capital, and we call that profit. So your profit divided by capital, that equals your ROI. So I just wanted to throw those formulas out there so you had them, because these all kind of work together. If you have a 3-to-1 reward to risk ratio, it does not mean you have a 300% ROI. It means that you're risking $1 for every $3 you're going to make. That's what a 3-to-1 reward to risk ratio is. If you have a 3-to-1, let's say you're risking $1 a share, it doesn't mean it only took $1 capital. Capital is how much money it takes to get into the trade. Risk is what you're actually willing to put at risk. Okay. So hopefully you've got that clear now. I want to set a trade up for you here. This is an example on QQQ. Let's just say that we were going to take an entry at $310 a share and our target was $335. And since this video is not really about analysis, just trust me on how we came up with these, but it's our most recent swing high over here. If you can see where my cursor's at. That's my most recent swing high. That's our next target. Entry is 310. Our stop is going to be at $300. So here's our math on this. If we get into this trade at 310 and we take our profit at 335, our reward on this trade will be $25 per share. See how that works? We get in at 310, we get out at 335. Our reward or our profit will be $25 per share. Now you can do the math and you can say if I'm doing 100 shares, it's 25 times 100. If I'm doing 50 shares, it's 25 times 50, whatever number of shares you're trading, okay? But we're gonna set this up, our entry price and our target price, the difference there is your reward. Now, the difference in your entry and your stop is your risk. So if we enter at 310 and we have a stop at 300, that's a $10 per share risk, okay? Now, if you do the math on that, if you're risking $10 a share and you're looking to make $25 a share, that's a 2.5 to 1 reward to risk ratio. You're going to make $25 for every $10 you put at risk. What about the capital piece of this? Here's how much the capital is. If you're buying the stock, you're going to pay the entry price, $310. So you're paying $310 per share. That's your capital requirements. If you're buying an option, I can't really tell you because every option is different. Depends on a lot of different things, but we'll say $10 to $12 per share for the option if you're buying the option. If you're buying it on margin, it would be 310 divided by 50. So you have $155 a share, divided in half, I should say, 50%. 50% margin is your standard. Okay, so there you have it. Capital is the amount of money that it takes to get into the trade. Risk is what you're actually willing to risk per share. Reward is what you're expecting to make per share. If you keep that ratio in at least a 2-to-1, ideally 3-to-1 or better, you will beat the market. And I promise, if you're one of these people that's been winning 50, 60, 70% of your trades and you're seeing your account go down, this will plug the hole. This will fix it right here. Okay. Hope you guys like this. Hope you have learned a lot from it. If you have learned something, then what you need to do right now is you need to like and subscribe, because it is a proven fact. If you like and subscribe, you learn more. So that's why you need to like and subscribe. And if you really want to learn some more, just visit us over at trademaestro.com, trademaestro.com, where you can see all the things that we have to offer over there, from memberships to our accelerator program to private coaching, and we do our weekly classes on Sundays and all the other stuff that we do. So yeah, if that's something you're interested in, then come check us out over at trademaestro.com. If you need to get some help, just send us an email, help@trademaestro.com. And until next time, I wish you the best, and I hope that you got everything you need out of this, plug all the holes, and go make lots and lots of money with your trades. All right, we'll talk to you soon. Until then, happy trading.